Welcome, Alan. After the jobs report on Friday, the better than expected non-farm payrolls, not so much so better than expected, but certainly the unemployment was. And then a lot of people are talking about that participation rate, which fell as well. I'm thinking that would bring a lot of focus to the JOLTS report in terms of the openings, and talk to us about some of the focus that's going to be on today's number as well.
Well, as a trader, it's not necessarily how the markets act, it's how they react. And that's what we're looking for now, is to see what the markets do after the much-needed profit-taking pullback that we've seen in equities. Now, it's a big macro picture, so you saw a lot of other markets follow, and you saw a little bit of a risk off, and saw some markets unwind, but that's healthy. That's what's needed to happen. Yesterday was key in the fact that we saw some new relative lows in the stock indexes, but not new relative highs in the VIX. So the VIX did not make higher highs, even though the market made lower lows. That's very much a positive, very bullish. And having the NASDAQ pull back 10% after being up 75%, that's not catastrophic.
Yeah, not seeing the VIX make higher highs definitely helped calm investors' concerns some, and we're seeing indices pull back a little bit today. Maybe it was just a pullback. And then on top of that, Alan, as you were saying that, I just realized that, well, we didn't take out the September highs in terms of the treasuries either. You would think that if there was a major concern associated with that selling over the last few days, we'd be trading above those SEP highs that we saw the bonds in the mid-178 handle, and ultimately even above the August highs. I mean, we were all the way up in the 181 handle back in the beginning of August, middle of August.
Exactly, Ben. You and I are old school. That's how we used to watch and see where the flight to quality was going. Before they invented the VIX contract, that's how you knew the money flow was changing. That's how you really knew if things were serious. You would look to see how the bonds reacted. Yeah. And, people don't do that anymore like we did as kids, but that's really a great indicator of that the fear was not as much yesterday as it has been.
Yeah, I know we wanted to talk financials here, but also one could argue, I mean, gold also didn't really see a reflection of that either. I mean, I guess I'm wondering, what does that tell you, Alan? Does it tell you that this was, at the very least at this point, still not a major concern for investors? And it is, as you kind of hinted at in the beginning of this discussion, that this is more a healthy pullback?
Yeah, markets need to pull back. Now, we've seen this many times before. If you look at the NASDAQ in the last year and a half or 2 years, you think I've seen 10% pullbacks, and what happened each and every time? It rallied and made new all-time high. So until it doesn't, we have to follow that path of least resistance. And let's remember, the S&P is still 50% off those lows. So, we had some unwinding, some tech stocks that maybe got a little ahead of themselves. But, if you look at the big picture, we're still very much in an uptrend. And anybody that's tried to pick this top or turn has not been successful in not just this year, but I'm talking about in the last decade. So I would be more inclined to be looking at the risk reward and finding opportunities after a sell-off as opposed to selling into this, because we've seen every time in the past, those people that sell into this, if they don't take the profits immediately, guess what? We see new highs.
Yeah, certainly. I mean, we've been talking a lot about how the bulls have been rewarded by positioning themselves with the trend of the upside, and those who have been fading this move, you better be fast, otherwise you're getting run over. Let's talk about what could shift some of the momentum, Alan, and what could change that in terms of your bias towards the buy side here, still in buying dips or pullbacks and looking for the trend to resume. Let's talk about central bank activity headed our way over the next couple of weeks. Are you expecting them to say anything? We got the Bank of Canada today, ECB tomorrow, and then Bank of Japan and the FOMC next week. But are you expecting them to say anything that could slow this momentum or even derail it and kind of change investor sentiment? Because it sure seems that accommodative rhetoric has been, well, a big part of what's been behind this bid.
Well, it's not what they say, it's how the market moves. And we'll see if the dollar can test those lows one more time. We're still between the 92 and 94 in the dollar index. And that's really the big picture here. So we're hovering around this 93 midpoint of this sideways action to see what the next leg is. Now, the ECB is looking to come out, and they're probably going to be talking down their currency. No one wants to have this strong currency. The 120 level in the euro is the halfway point of the last 20 years. So that's a key level. It's not been able to punch through it significantly just yet. They're in a range there, kind of a flag pattern between 117 and 120. The dollar's in a basing pattern. So we'll have to see what the markets give us next. But globally, everybody's in the same place we've been. I think, as long as I can remember, everybody's having a race to the bottom. No one wants to have the strongest currency. And let's see if the dollar can hold this, I wouldn't call it strength, but let's say steadiness in the last few weeks and see if a bottom's in place or not, because that's the big question. I think the path of least resistance is still down in the dollar. Let's see what the next leg does.